what's going on in the market, guys? You guys all know what's going on. It's a lot of good news, some bad news. What's going on? You guys tell me. What are you seeing? What are you hearing? What are you reading? You guys are keeping track or no? Yeah, who said that? Rates went up. Yeah, rates have been going up for the past few days. Actually, really for the past few weeks.
10-year Treasury's been the highest in the past year.
Yep, exactly. Right. So CPI just came out, right? Nearly doubling. We're at 6%, right? Causing pressure on mortgage rates now, right? So definitely not good times, right? Even I am kind of stumbling for words, not because I can't explain this, but because it's not news that we want to hear, but it is the reality right now. Okay, with the oil, the continuing, the war, crude oil prices going up, inflation going up. Really, inflation has not just to do with the oil, but just overall. Like if you go to the grocery market, are you guys noticing things are a little bit expensive or more? Not just gas. So this is going to definitely put pressures on the bond market as it has. It's going to ultimately affect mortgage rates. We've kind of beaten that one to the death for the better part of this year. So what do we need to do, guys? Right? I have, some of us here have been through many peaks and valleys in our industry, in our tenure in this industry. Coming in at 2009, many peaks and valleys. Personally, for me, there were 4 really, really big ones. And sometimes you just have to kind of sit back, right? Take the wins that you guys have right now, as if you guys have shared. That's great. Be encouraged. Some of you guys are going to be in the forefront of the bad news and negativity, right? And the pessimism you're gonna face in here. Some of us, that's ahead of us, and it's a big battle right now. Okay, and just a word of encouragement. Number one, it's cyclical. Okay, just like a relationship. Okay, just like your relationship with food, perhaps, right? You can't always enjoy a certain type of food. Your relationship with your girlfriend, your fiance, your spouse is never always on a high note. Likewise, our industry is the same thing. We will never always be feasting. There will come times of famine. There will become times where you just lose your appetite for a certain type of dish, food, or restaurant. And yeah, there's similarly, there are times where you just don't like your spouse or significant other. Okay, hopefully that one doesn't last too long. In an industry, unfortunately, there are many outside external factors that we don't have control over. Okay, but how do you fight against that pressure? Okay, I just want to show you guys this just because, we at Giving Tree have been talking about this since we've been meeting together, but I just want you to see the headline. Okay, non-QM is no longer a niche product. It is one of the biggest growth channels in mortgage today, and the brokers leaning into it are taking the market share. Right? Simple email. Okay, perhaps you've already seen it. It's through JMAC. I'm going to be honest, I've never used JMAC, but there's a lot to take away from, a lot of truth to take away from that headliner. How long have we been talking about non-QM? It is here to stay, and it is the fastest growing product programs in our industry. So much so, I think I shared with you guys that we had a loan officer attend the Mortgage Expo last week. They barely were talking about non-QM because it's a thing of the past, right? So, I was doing some research online, right? And do you guys have you guys all heard of the IRS tax gap? Do you guys know what the tax gap is? No? Mm-hmm. So the tax gap, and I'm just going to summarize it, is basically it's a projection of tax liability that IRS anticipates to collect based on earnings. Okay? And then there's what's actually being reported and filed. Does anyone want to take a guess right now as to what that tax gap is? How much it is? I know you guys are all behind a computer right now and probably could look this up, but just want to take a wild guess what that tax gap is.
50%?
Not no, but now I don't know that, but money wise, or in terms of a dollar, how much? I could calculate it for you in the percentage. But do you guys want to throw out a number?
700 billion.
Yep, $700 billion, guys. 700 billion. So, percentage wise, it's around 20%, Alex. Okay. That's, I mean, by any measure of anything we do, that's a very big percentage. Okay. And that's a lot of money, $700 billion. Okay. And why do I bring that up? Well, because those who are, contributing to this tax gap, okay, most likely probably won't be able to qualify through a conventional means, right? How many of you here, by just a simple raise of hand, has dealt with now or procured a loan through a non-QM product? P&L, bank statement, DSCR, VOE, asset depletion, right? Thank you, Michael. Thank you, Peter. Right? It's probably all of us here. Okay. And are the house prices here falling, or is it growing? Is it unaffordability growing or falling? It's growing, right? So you guys keep in mind when news articles come out and say, oh, house prices are dropping, it's not that the value of the house itself is dropping. It's the rate of the appreciation. Okay. You guys got that, right? So you have this $500,000 house, yesterday, that $500,000 house isn't, when it says, hey, the value of homes are dropping, it doesn't necessarily mean that the value of that house now is $490. Okay. It just means that, right, it was appreciating to expectedly to be $520, but instead of $520, it might be $510 or $505. Okay. Prices of homes are still growing. Okay. Tax evasion and the tax gap is still widening. It's the biggest it's ever been. So non-QM is there to help solve that solution, to bridge that gap. Okay. The last thing I want to say is, so yes, get yourselves to be familiar, to be the masters, to be really the subject matter experts in a non-QM. Okay, and go and preach that. Okay, share it. Okay. And number two, as I'm gonna reference a good buddy of mine. His name is Cole Harvey. He is the owner and broker of Lifetime Realty. They were number one in 2005 in all of Orange County. Okay, and his words to me just 2 days ago, or yesterday, I'm sorry, was, "You just have to do more." It was just simple words, right? And those are words that I want to share with you and relay that to you, for you loan officers who want to produce in times like this, where it feels like it's a little bit more famine than it is feasting. Just do more, okay? More calls. So they said that right now, so every Monday or semi-annually, they have a cold call night, a cold call morning rather. So they get together at Lifetime Realty and they call for a duration of 6 weeks on Monday mornings. They make calls, whether it's FISBO calls or expired listings, right? And their whole thing is try to make 100 calls a day, right? 100 calls a day, and that within that time. Right now, that they're finding that they're exceeding themselves just to get someone on the phone, north of 200.
Mm-hmm.
So your agents are working hard right now. The agents that are producing, not the zeros and ones and twos a year, but those who we want to work with, those agents are working hard. The ones that are willing to, okay? The ones that are winning right now, they're making more calls and working harder. So who is it for us to say we shouldn't work as hard? who is it that we should say we should work the same right now? Okay, so I want you guys to just be encouraged, okay, but also just to be reminded right now that look, we gotta call it out, a spade, right? This economy is tough. There are a lot of outside factors that we can't control that it's hurting our business. But in order for us to win, we just have to do more. Okay, don't be afraid of it. Okay, if you guys like sports, I love the sports analogy, right? When Kobe Bryant tears his Achilles heel, what does he do? Does he sit there and just ice it? Does he take this time just to sit down and do nothing? No, he works even harder, or he worked even harder, right? The moment he could stand up, even when he was barely standing, he took more free throws, he took more shots. It's no different for us as loan officers. It's tough market. It isn't. We're fighting inflation. We're fighting a war. We're fighting this and that. Doesn't matter. Just work harder. Today, with that being said, Peter's going to go over a non-QM product. So the floor is yours, Peter. Thank you.
Thank you, Ragnar. Today's phenomenon is very different and very exciting to see. What we've been emphasizing for the last 2 years is now shining right in front of us. So I want to share some of the screen details and then begin from this price comparison. So on the loan sifter, imagine that you have 1.275 purchase price with loan amount at 1.02 million. Typical Orange County, LA County purchase transactions. I'm going to compare in between the high balance, 760 FICO is A+ pricing, comparing between QM and non-QM and see what kind of a differences we see. With QM, NMSI is number one, giving us 1% rebate at 6.625. So I'm going to change the filter to 6.625 and see what a non-QM product, full doc, can provide us. 6.625, 1%, but NMSI has been pushed out. Now, change the product to bank statement loan. Let's assume that this is a self-employed applicant. Then what do we have? 6.625 at $14,000, 1.38. Now, what has changed? If it were a W-2 borrower applying, QM and non-QM are the same, but self-employed applicants will have better options or different options. Let's look at the P&L option. ARCOM. So we now know P&L is weaker than bank statement loan. Full doc and bank statement are as same or better than regular Fannie Mae, Freddie Mac high balance loans. So let's put that as a baseline. The reason is because of these two factors. 10-year Treasury bond, which is directly tied to our 30-year fixed mortgages, has been skyrocketed since March. We once had a 3.96 10-year bond less than 40 days ago. Now we have a 4.66. Now what do we do, right? If you look into the year to end and the 1 year mark, now we are exceeding the highest rate we had back in May of 2025. If you look into 5 year mark, we are at the same level as 2024 April. So thankfully, because of the other indices, we didn't have any 7s and 8s. We still have something in 6s. So don't be afraid of what's coming up. What we had back then, we were selling 7s and 8s. Now, because of other indices, differences, thankfully, even though 10-year bond at 4.6, we are able to still sell the mortgage rate at 6%. The reason for the non-QM, in my terms, are better than QM is because of different index rate, different indices, but specifically SOFR rate. When we look into the last 5 days, 10-year bond has been just going up greater than 30%. But if you go to SOFR, since 5 days ago, it actually went down. Now we can say SOFR rate and 10-year bond for the last 30 days has been inversely proportional to one another. That's why non-QM rates can be better. It was an option back then. Now it is always better and can be better throughout the time. If the 10-year Treasury bond goes and exceeds 4.7, Whatever the inflation rate that you have and come doesn't matter to us because we already have more than enough non-QM products ready to shoot. What I'm going to emphasize today is to go over what type of non-QM products we can sell today so that we have a better mindset and equipped so that we can reach out to the buyers who's ready to get better rate and better fee. Okay?